There are two pensioners, same country, same tax system, very similar income. On paper, they are almost identical. Let's call them John and David. They both worked for decades. They both built up a state pension. They both have a modest private pension. Their total income is about £18,000 a year. So, you would expect they would receive roughly the same amount each month. But they don't. John checks his bank account each month, like clockwork. He receives about £1,410, £1,410. He can manage his bills. He can help his grandchildren. He can plan ahead. David checks his account. He receives about £1,160. That is a difference of £250 every single month. Over a year, that is £3,000. And here is the uncomfortable truth. David has not made a mistake. He has not broken any rules. He has not taken more money than he should. The only difference between John and David is a small line of text on a pension statement, a tax code. In David's case, his tax-free allowance was sitting on a small £1,000 pension, while his main income was being taxed from the very first pound. And this is where the system becomes very quiet, because if your tax code is wrong, the system does not stop. It does not warn you, and it does not correct itself quickly. The tax is taken before you ever see your money, quietly, automatically, and often for years. So today we are going to slow this right down, and I'm going to show you what a tax code really does, why it goes wrong so often, which codes you must recognise instantly. I'll give you 3 real-world examples with clear figures and exactly how to check and fix it. Because once you understand this, you stop losing money silently, you stop relying on guesswork, and you take back control of your income. Hello, it's Angie, and this is UK Money Wisdom. So why does this matter? It's not about avoiding tax. It's not about beating HMRC in any way. This is about something much simpler. Paying the correct amount of tax. No more, no less. Because right now, many pensioners are not. And the reason is not lack of effort. It is lack of visibility. Let's get into it and understand what a tax code really is, because many people think a tax code is just a number, something technical, something administrative, something HMRC deals with somewhere in the background. But that belief is exactly where the problem begins, because a tax code is not passive, it is active. It is not a label. It is an instruction. It tells your pension provider or employer how much tax to take before your money reaches you. So, imagine your income as a stream. Your pension is flowing towards you. Your tax code sits in the middle, and it acts like a gate in the stream. If the instruction is correct, the right amount flows through. If the instruction is wrong, however, too much is taken, and nothing in that pauses to check with you first. Let's start off by looking at a table showing a simple standard tax code. And you see that tax code is 1257L. The number 1257 represents your personal allowance. Add a 0, that's all. 12570. And hey presto, that is the amount you can receive each year before income tax applies. The letter L simply means you are entitled to the standard allowance. Now here is the key point. You only get this allowance once. Not once per pension, not once per income stream. Once. And it has to be allocated somewhere. If your allowance is placed correctly, everything works. If it is placed incorrectly, you overpay. So why do tax codes go wrong? This is not random. It follows a very clear pattern. HMRC does not always have a real-time, fully accurate picture of your income. Instead, it works with previous year data, estimated figures, partial updates. Now that can work reasonably well if your situation stays stable, but retirement is not stable. It is one of the biggest financial transition points you will ever go through. So what changes at retirement? You may suddenly have state pension starting, one or more private pensions, flexible drawdown, part-time work, savings interest, and each of these is treated separately, and your personal allowance must be assigned somewhere within that structure. Look at this table which shows the allocation issue. Here is the problem. The system does not optimise your tax position. It simply follows the instruction it has. State pension uses the allowance first. Private pension becomes often taxed. Job income may be taxed separately. So if those instructions are wrong, your outcome is wrong. This is not unusual. This is built into how the system operates. Now, let's look at some red flag tax codes. There are certain codes you must recognise instantly. Look at this table. Now, these codes are not always wrong, but they often are. BR, that means 20% on all income. OT, no allowance applied. And K, negative allowance. So, as I say, these codes are not always wrong, but they often are, and they are signals. They tell you to check. You may also see codes like 1257L and M1 after it, or 1257L, W1 after it, or 1257L with X after it. These are emergency versions of the standard code. They ignore what you have earned earlier in the year and can result in too much tax being taken. Let's take the BR code. BR stands for basic rate. BR means everything in that income stream is taxed at 20%, with no allowance applied. Look at this table to see the impact of BR codes. If your allowance is already taxed elsewhere, then BR may be correct. But if it is not, you are overpaying. Now that difference might look small, £120 per year, but over time, say 10 years, that's £1,200, and over 20 years, £2,400, quietly lost. In this next code, the OT code, this code removes your allowance completely Everything is taxed. Look at this table to see the OT impact. And this often happens when new pension starts. You have missing information, or there's a transition between providers. The key point I am making is that many people assume this is correct and they leave it unchanged. Now, this next code, the K code, confuses many people. K codes mean HMRC believes additional tax is due. So instead of sending a bill, they collect it through your income. Look at this table to show the K code effect. Your allowance is reduced, so more of your income is taxed because you only have £9,570 allowance left. In this worked example, we see Linda has a state pension and a private pension. So what's left of her tax-free allowance? You can see tax-free allowance left is only £22. Now, let's look at how the private pension is taxed. There we go. There's a taxable amount of £2,978 because of only £22 personal allowance left. And Linda is taxed at 20%. She pays £596. You see, most people think my private pension is only £3,000. That's small, so tax will be small. But here's what's really happening. The state pension has already used almost all of the tax-free allowance, hasn't it? So only £22 remains. And almost all of the £3,000 becomes taxable. Here's the key point. It's not the size of the private pension that matters. It's how much tax-free allowance is left. And in Linda's case, there's almost none left. And in 2026-27, the state pension now uses almost all of that allowance on its own. So what happens when the amount increases? Let's change one thing. Nothing else. Not the rules, not the system, not the allowance, only the amount. Look at this table where you have higher private pension. You see the correct tax would be on £9,978, which are the two incomes added together, state pension and private pension, less personal allowance. So tax at 20% will be £1,996. So what does this show? Nothing has changed except the size of the withdrawal. The allowance is still already used, so almost all the private pension is taxed. But now the tax is no longer £596, it is nearly £2,000. And the key point? When your allowance is already used, every extra pound becomes taxable. And the more you take, the bigger the tax becomes. So far, everything we've seen has been correct tax, but now we move into a situation where the system does not behave as you expect. Look at this scenario with the drawdown moment. Imagine you take £10,000 from your pension. You've heard the rule, 25% is tax-free. So naturally you think, I shouldn't pay much tax, but what actually happens can feel completely wrong, because you might see £2,000 or more taken immediately. Even in a situation where you may owe no tax at all. Let's break that down clearly. Look at this table. You see the drawdown structure. 25% is tax-free, but we must look at the remaining 75% that is taxable. This table shows you what you actually receive on that £10,000. You have tax-free £2,500, but £7,500 is taxable income. Now let's look at two real-life outcomes. Look at this table. Person A has got no other income. There we go. £7,500 taxable drawdown. Personal allowance, £12,570. Tax due, 0. The full allowance is available, no other income, so no tax should be paid. But look at pension B, with a state pension in place. Now, you see the allowance remaining is only £22, isn't it? And taxable drawdown of the £7,500 means tax is due for B of £1,500. And here is the problem. In this table, you see what HMRC often sees. In this table, you see what HMRC often does first. Looks at the withdrawal of £10,000 and it takes straight away £2,000. And so why does this happen? This is a monthly payment. So it treats £10,000 as if £10,000 is taken every month. That's £120,000 a year. And that leads to emergency tax code, higher rate assumptions, too much tax taken up front. That's what HMRC sees, and that's what HMRC does. So what's really happening? The critical point is there's the same £10,000 withdrawal, completely different real outcomes, but both can see too much tax taken first. A, with no income, has £2,000 taken initially, and B, with a pension, also has £2,000 taken initially. In this case, the system guesses first and corrects later. Let's look at an example of a working pensioner. Now, this pensioner has £12,000 in earnings from his job, and his taxable amount is £11,978. Tax at 20% is £2,396. The key point being the allowance is already used, so the job income becomes taxable. With only the state pension, that's the £12,548, taxable amount is naught and tax is naught. The state pension is now just below the personal allowance. It uses almost all of it, as we know, we've talked about it, leaves only a very small amount of £22 tax-free space. But the key point is we are now extremely close to a position where state pension alone becomes taxable. This is what you must do. Check your total income. Check your tax code. Check how allowance is allocated. And this is how to fix the situation. Go online, update your income via personal tax account or phone. You can call HMRC, and here's the number, 0300 200 3300. If you need a refund, claim back your overpaid tax. This is not, as I started off by telling you, about avoiding tax. It's about paying the correct amount right from the word go. Because if your tax code is wrong, you lose money before you ever see it. But once you understand this, you take control back. You stop the silent losses and you make the system work properly for you. So check it, understand it, and fix it. Because once the wrong code is in place, The system will keep taking until you stop it. Please remember this content is for general information only, not for personal financial advice, but it is based on current UK tax and pension rules and public guidance for the 2026-27 tax year. And remember, individual circumstances vary and tax rules can change. I do hope this video has helped you, and if it does, please subscribe and like to be sure of getting more of my videos. And if it helped you, perhaps it might help a friend, so please do share it with someone you care about. I'm Angie, and this is UK Money Wisdom. I'll see you very soon with the next video. Bye for now.